The Roth IRA is one of, if not the best investment account that you can use to invest and retire completely tax-free, where you can see this article by Empower shows how young investors are turning to Roth IRAs for retirement planning, where it's been reported from the Center for Retirement Research that 41% of people contributing to an IRA or Roth IRA are under the age of 40, compared to that being 29% just a few years ago in 2019. And from the tax year of 2022, 39% of Roth IRA owners made contributions when compared to 22% of traditional IRA owners. Which, not to mention, but the total IRA inflows have been growing at an incredible rate over the past few decades. Now, both traditional and Roth have their time and place depending on your situation, but because of how beneficial the Roth IRA is, specifically if you understand how to use it properly, from all of the research and content I've created on this topic over the past few years, I'm about to go over an entire Roth IRA blueprint, starting with a quick overview to the Roth IRA, how to get started, what to invest in, and what to avoid in order to maximize the opportunity to live completely tax-free in your retirement. But before we get started, my name is Sully, and all I ask is if you do find value in this video, that you consider hitting the like and subscribe button for future content like this. With that said, let's first go over a quick Roth IRA overview. Now, for those that don't know, the IRS refers to IRAs as individual retirement arrangements, but you might also hear others refer to them as individual retirement accounts. And so the biggest thing to understand here is that the Roth IRA is a type of investment account, and the reason it is unique is because of how it is structured, especially when it comes to tax purposes. You see, the main idea on how a Roth IRA works is that you first open an account, you contribute after-tax money, which means it's money you pay taxes on in the year that you contributed it, where you can then manage and invest however you want inside of this account, where you can grow your money completely tax-free. And once you reach the age of 59 and a half or above, assuming you've met the 5-year rule, which depends on when you contribute, converted, or inherited funds, but any time after that, you can withdraw from the account however you want, completely tax-free. And so a few things to understand about this account is that the IRS has a rule that limits how much you can contribute into the account each year, known as the contribution limit, where for the year of 2026, the limit has just increased to $7,500 per year. And if you're at the age of 50 or above, you can make catch-up contributions, which is an extra $1,100, allowing a total of $8,600 to contribute each year. But besides the contribution limits, understand that the Roth IRA also has income limits, which means depending on the amount of income you earn in a given year, you may or may not be able to directly contribute to your Roth IRA. But do know that there is a legal way around that called a backdoor Roth IRA, where Vanguard states it's as simple as placing your contributions into a traditional IRA first, which has no income limits, then you move the money into a Roth IRA using a Roth conversion. Now, if you're one looking to do that, I highly recommend you do your own research and talk to a professional to ensure you do things properly. But another thing to know for those in the worst case scenarios is that you can actually withdraw anything that you contribute into a Roth IRA completely tax and penalty free. But if you withdraw any earnings before you become eligible, then that means you would have to pay taxes on the earnings, and a 10% penalty fee would likely apply, unless you are exempt due to certain factors like a first-time home purchase, qualified education expenses, or a certain emergency, to name a few. And then besides that, another benefit to the Roth IRA is that there are no RMDs, which stands for required minimum distributions, where a traditional IRA, because they have RMDs, once you reach the age of 73, you are required to make withdrawals from the account, which you also have to pay taxes on the withdrawals due to the structure of the traditional IRA. All right, so knowing all that about the Roth IRA, let's now go over the process to getting started. Now, when you're in the decision of where to start a Roth IRA, there are many solid brokerages to choose from, and the choice really comes down to what you prefer most. For me, the one I chose and plan to stick with is Fidelity, and if you're one looking for an old school brokerage firm that has been around for many years, two other ones I'd recommend to consider and look into more is Charles Schwab and Vanguard. Or if you are one that would prefer to look into a newer platform, ones like Robinhood or SoFi offer solid options and may even offer welcome bonuses or contribution matches to your IRAs. But besides that, let's say that you want to be hands-off, especially if you're brand new to things, then you may really want to consider looking for a robo-advisor, where many of the companies I just mentioned have great options, but you may also be interested to learn more about other ones like Acorns, Betterment, or Wealthfront, which I will say if you want to see some of the top options to compare, I'll have an entire review page from my startup InvestLane that I'll have linked in the description below. But from there, because I use Fidelity, let's use them as an example, and do know that I am not affiliated with them at all, although I wish I was. But notice that when you go to open an IRA, depending on the broker, you have the choice to select your own investments and manage everything on your own, or you can start with a robo-advisor like Fidelity Go that helps personalized based on your own situation. And then of course, if you have a financial advisor, you could talk to them on this topic as well if that's what you'd like. But let's say you want to control this account completely on your own. It's really as simple as filling in your personal information to create an account, and depending on the broker you use, they will likely show you how much you have contributed so far in the given year and how much you have left that you were able to contribute before you hit the max. For most platforms, you will also be able to set up recurring transfers. So let's say every 2 weeks you get paid and you want to treat your Roth contributions like a bill. Let's say that you set it up so that every 2 weeks you have $275 going into your Roth IRA. By doing this automatically and throughout an entire year, that'd be 52 weeks, that means that 26 recurring transfers of $275 would mean that after a full year, you would end up contributing $7,150. Now, the process to doing this and the features on each platform depend on the broker you use, but the main concept here is that once you create an account, if you choose to manage the account on your own, you can then have control over any of the investments in the account that you want to purchase. And even better is that because it is a Roth account, everything in the account grows completely tax-free, and even if you wanted to switch investments, there is no capital gains that could be triggered because it's sheltered in the Roth account. So let's say that you buy an investment right now, and then a year later it grows a ton and you would like to get out of it and make a change. You would not trigger capital gains in order to make that switch. Or another nice benefit is that if you pick an investment with dividends, you are also never taxed on the income, which allows you to have even more potential growth, because in a normal taxable investment account, that would lead to what's called tax drag, because dividends are taxed whether you reinvest them or not. But all in all, this account is extremely powerful to lead you into a successful retirement, and for many of you watching, especially if you're on the younger end, it would likely be very beneficial to get started as soon as you possibly can, which is why the next thing to cover here is what to invest in. When it comes to investing in the Roth IRA, there are many investments that you could choose from that, especially for beginners, things could feel very overwhelming. But to sum up some of the best ways to invest in a Roth IRA, a core topic I talk about on my channel and even my new startup InvestLane are what's called index funds, which are pretty much a way to buy hundreds to thousands of different investments that track a particular market segment all within one purchase. And so the number one index fund to mention here is what the legendary investor Warren Buffett actually recommends, and that is the S&P 500, where he even suggests Vanguard's, where they currently have the most popular ETF in the market based on its assets under management, and that is the Vanguard S&P 500 ETF with a ticker of VOO. And then if you have a Roth IRA through Vanguard, you could choose to buy their mutual fund version that is VFIAX. Now, because I know this can come off confusing, just understand that an index fund can be structured as either a mutual fund or an ETF. In this image that we designed at InvestLane, you can see the exact reference to Vanguard's S&P 500 Index Mutual Fund that is VFIAX, or their index ETF that is VOO. And before I list off any other index funds, please understand that this is not financial advice and you have to do your own research and make your own investment decisions. But a slogan for the Roth IRA that I believe is beyond crucial to remember is growth now, dividends later. The reason is that I see many investors out there that want to build this ultimate diversified portfolio in their Roth IRA that includes dividend investments, bonds, and other ways to diversify and reduce risk for a portfolio so that you could have your money grow steadily over time. In fact, even in my first few years, I owned a small portion of bonds thinking that I was being smart to allocate an ultimate portfolio, but all I learned after a while is that I would have done much better if I just stuck to what I know today, which is why I'm making this video in hopes that it could help others prevent making the same mistake. You see, the Roth IRA is meant for retirement. So if you're in your teens, 20s, 30s, even 40s, you still have so much time until you should be even touching these funds that investing for growth now can pay off significantly down the road and potentially save you from many years of extra work and financial stress. And so because of that, unless you believe a certain dividend stock or bond is likely to outperform the S&P 500 over time, I personally believe that if you have at least 10 to 15 years until you're close to retirement, that investing for growth now can be extremely beneficial to build up your portfolio large enough so that in the end you could have a tax-free dividend income that is sufficient enough for you to last the rest of your life, and the account could still continue growing. An image I love referencing here shows the rolling returns from owning the S&P 500 over 3, 10, 20, and 30-year periods, where the 3-year periods in blue are very volatile, 10-year periods in pink are much less volatile, and only a few times investors would have lost or barely gained a return. But best of all is that the longer the time horizon that you stick with the S&P 500, which by the way, this is almost a century of data, just looking at the 30-year periods alone, pretty much all of them would have averaged about 8 to even 14% of annual returns for investors. And not just that, but data shows that since 1957, the S&P 500 has delivered an average annual return of 10.56%. So let's say that you are just starting your career today at age 25, you have never had a Roth IRA before, and you decide to invest $600 per month into the S&P 500, then that means that you would end up having $2.3 million by the time that you're 60, and with a 2.5% inflation rate, that means that it would be equivalent to someone today retiring off of $1 million. Now don't forget that this is solely for the Roth account. You may very well have other savings or income sources on top of that, but let's say that since you started, you took a more diversified route, being a bit more on the conservative end, and let's say that you averaged 2% less over time, then that means that you would be missing out on almost $1 million of potential growth. So these are all simple calculations and no one knows what the future holds, but when I hear many young investors that are loading up on solely dividend ETFs like SCHD in a Roth IRA, if we look at the past 10-year performance, SCHD averaged 11.38% per year, where VOO was 14.58%. And don't even get me started with bond funds like BND that have averaged 1.99% per year, not even keeping up with inflation. All in all, if you have many years until you plan to touch the funds in your Roth IRA, remember, growth now, dividends later. To give you a quick summary of top picks for each, starting with the growth, to keep it simple with ETFs, I personally like VOO for large cap exposure, Vanguard's total stock market ETF VTI if you would instead like to add some exposure to small and mid cap US stocks as well, then VUG, SCHG, or QQQM for growth oriented large cap US companies, or for those that want to look into sector ETFs, you may find ones like Vanguard's Information Technology ETF VGT to be very interesting, or Vanguard Semiconductor ETF that is SMH, or the S&P 500 Momentum ETF that is SPMO, or a mid-cap Momentum ETF that is XMMO, or you may even want to take interest in other areas like gold with GLDM, crypto like Bitcoin with Fidelity's FBTC, or the popular iShares Bitcoin Trust ETF with the ticker of IBIT. And if you are one that wants to diversify even more with equities, you may want to take your chances with ETFs like the Small Cap Value ETF AVUV, the Dividend Growth ETF that is DGRW, and then the last, if you particularly believe in international exposure to perform well in the future, then you may want to consider a small portion to an ETF like VXUS, VEA, or IEFA. But do know that US stocks have proven to outperform international over the long term. Now, I also want to point out that I am not specifically bashing on SCHD. It is a great investment, and I actually believe it is the best overall dividend ETF in the market, but any dividend funds specifically that are very likely to underperform the S&P 500, I find them irrelevant when you're in the growth phase of investing, which is why any time that I hear someone young investing and only buying dividends in their Roth, I immediately say, growth now, dividends later. But in the end, the choice really comes down to your own situation, how you want to diversify, and what you feel can do the best for you. I just honestly want to emphasize the fact that many of the funds that are more growth oriented over decades of investing, you're very likely, at least in my opinion, to average at least slightly better returns if you hold on long enough. But knowing that, let's now talk about when you hit later in life when the portfolio is built, when it's time for the dividends. You see, the best part about the Roth IRA structure is that you don't trigger dividends to change investments, and any income that you end up generating, say it's dividends or interest interest from things like bonds in the future or money market funds, no matter the tax efficiency, it doesn't impact you when it's sheltered inside a Roth. Now, it would be wise to slowly transition into safer investments as you get closer to retirement because the stock market is volatile and no one knows what could happen. But to keep things super simple, let's use the previous example and say in 35 years you end up having a $2.3 million tax-free Roth IRA portfolio, which don't forget is equivalent to $1 million in today's market when we factor in inflation. Now, I plugged in a simple 5 ETF portfolio into Seeking Alpha, which they have solid research tools for investments, and if you want to check them out, I'll have a direct link in the description below for you. But of the 5 ETFs, let's say I pick SCHD as the core, making up about half of the entire portfolio with just over $1 million, and you can also see that SCHD's yield over the trailing 12 months was 3.82%. Then the rest of the ETFs I evenly split by 4, that is from the S&P 500 ETF VOO, then JPQ and JEPI, which are 2 very high dividend paying investments, and you can see that their yield over the trailing 12 months was 9.46% and 7.46%, where DGRW is the last ETF to mention here, and the yield is very similar to the S&P 500. But the nice thing here is that for those in retirement, funds like JPI, JPQ, and DGRW pay dividends out on a monthly basis. Now, also know that JPI and JPQ are very inefficient when it comes to taxes, so I personally only recommend them in tax-sheltered accounts like this Roth IRA example that I'm showing you. But knowing that, notice how the current estimated annual income from this portfolio would be $109,000, and that comes from the annual yield being roughly 5%. To put that into perspective in today's economy, that would be equivalent to $45,000 per year, which is almost $4,000 a month. But do know that is completely tax-free, and with equity investments in the portfolio, your portfolio would still be very likely to keep growing, and if it averaged 10% per year over time, that means that it would still outgrow inflation and provide an income that you could live off of completely tax-free. And don't forget that you could always adjust positions however you want, whether you want more dividends for the income or more growth for the appreciation in the portfolio's value to grow more over time. But knowing that, let's finish off this video and go over what to avoid when using a Roth IRA. Now, to prevent this video from being super long, here is a quick list of 10 things to avoid when using a Roth IRA, and the first is waiting too long to start. Being humans, it is super easy to say, I'll get to it later, then something like this, all of a sudden months and even years go by, and then you have regrets and say that you wish you did more or started earlier. And so the first thing is to start right away, and don't forget I'll have a direct link below to a review showing many of the top IRA accounts that you may want to consider. Aside from that, the second thing to avoid is contributing too little. While it's great to at least start and contribute something to gain a feel for investing, if you consistently contribute too little over the years of your career, you may end up not having as much as you initially anticipated. After that, the third thing to avoid is ignoring inflation because, as I mentioned earlier, $2.3 million might sound like a lot right now, but in 35 years, that is equivalent to $1 million of today's value. And depending on how you live, that might not be enough to retire completely off of. In fact, there are many articles that talk about how inflation is currently pushing many older Americans into unretirement. But from there, the fourth thing to avoid is a lack of portfolio awareness. When I say this, I am referring to concepts like growth now, dividends later, and fully understanding how you invest, because the impact of understanding your portfolio can make or break your future, which is exactly why I create all of the content I do and why I just recently started InvestLane. Which I will say, if you are finding value from this video, don't forget to hit the like and subscribe button, and to also consider checking out the InvestLane YouTube channel that also has content very similar to this that I think you could greatly benefit from. Which, not to mention, but it's completely free. But from there, the fifth thing to avoid is overlooking fees. Whether you feel that you need a financial advisor or a robo-advisor, or you start purchasing funds that have high expense ratios, which is the annual cost to own the fund, then the fees can significantly impact how much you end up having in your pocket over time, which that is exactly what drives our mission at InvestLane. That is to help you save and invest wisely to build lasting wealth. After that, the sixth thing to avoid is selling during market downturns, which is the worst time to sell. And a few data points I love to refer to here show how if you missed just 10 of the best days in the market from 1995 to 2024, then you would have generated 54% less than if you held the entire time, which from a $10,000 investment, that would have made the difference of $225 $124,000 or $102,000. And even more importantly from this image, 50% of the best days for that 30-year period happened during a bear market. Now, especially in a Roth account, you really want to treat this as a hidden treasure chest, bury it, automate it, and forget it until later in life. After that, the seventh thing to avoid is relying on other income sources like Social Security for retirement, because that is likely to decline, and the best thing you can do is control what you can control. Which the eighth thing to avoid is withdrawing from your Roth IRA early, because the biggest advantage of a Roth IRA is allowing your money to stay invested and grow tax-free over time. Which, not to mention, but you could end up paying taxes and even a penalty fee, which compared to what you could get in retirement tax-free, that can be a huge impact. And then the ninth thing to avoid is that you may actually be in a situation at some point in your life that contributing to a traditional IRA would be more beneficial for you. Say you're in your 50s and you have a high tax bracket, using a traditional IRA can allow you to get a tax deduction on what you contributed into the account, and the worst thing here would be RMDs at the age of 73, but if your income is going to be low, which for many that is very likely at that age in retirement, then the impact is much less and you would still be able to defer taxes as you invest throughout the years. And then last but not least, the 10th thing to avoid is not having a clear withdrawal plan. For many, withdrawing may still be very far away, but understanding why you are investing now and understanding how you are going to do the transition and the end idea of how you are going to actually manage this is always great to have a clear idea. It's also really important to understand for later in life when you begin to withdraw, because whatever you take out of the Roth can never be put back in besides the contribution limits that you can put in every single year. So with all that said, if you have any questions or suggested content to be created, let me know in the comments below. And don't forget, if you want to check out some of the top IRA accounts or even Seeking Alpha that I showed you for investment research tools and analysis, I'll have direct links to both in the description below. Which, not to mention, but I've also created plenty of other free resources related to this topic, which I'll have those linked in the description below as well. And as always, don't forget to hit the like, subscribe, and notifications button for future content like this.